Hello and welcome to the Tax Roundup for October. Inside this month, we're going to take a look at the Board of Taxation's consultation into the residency rules for individuals. And this is trying to clear up those grey areas and simplify the process. We're also going to take a look at the ATO's latest deduction target. Yes, there is another one. This time looking at home office expenses and looking at what's actually required to claim those deductions. But first up, Michael is going to take you through the tightening of the small business CGT concessions and the legislation that passed Parliament just recently. Across to you, Michael.
Now we finally have legislation which deals with the small business CGT concession changes that were announced back in May 2017. Now this has been a contentious area, not only contentious in terms of the changes that are being made, but what the starting point and the effective date of those changes would be. Now the government had kind of stuck to their original position that these changes should be effective basically from 1 July 2017. So any CGT events involving shares in a company or interests in a trust could potentially be affected by these changes from 1 July 17. But a number of organisations and bodies suggested that that wasn't really fair because we didn't know what the detail of those changes was, any detail of those changes, until some draft legislation was introduced in February 2018. Fortunately, the bill has been amended, the bill has now gone through Parliament. The amendment is to defer the start date till 8 February 2018 when that draft legislation was introduced, and we finally had a real sense of what these changes actually involved. So for clients who have some sort of CGT event relating to shares in a company or interests in a trust from any point onwards from 8 May 2018, you will need to consider the possible impact of these changes now that they've been passed. Now they're not really relevant to other situations. If you're selling land, if you're selling goodwill, the rules really don't have any direct application to those situations unless that event takes place in a company or trust, and then there's a secondary CGT event later down the track involving shares in that company or units in that trust. For example, it might be on liquidation of the company. There could potentially be a capital gain for the shareholder when tax-exempt amounts come out of the company. If that's the case, well, you will need to consider these new changes. What the changes are really aimed at is making it more difficult to access the small business CGT concessions when the capital gain relates to shares in a company or interests in a trust, some additional tests, and then some modifications to the existing rules. In terms of the additional tests, the two main areas where you'll need to do some work, firstly, as well as testing whether the shareholder or unit holder passes a $6 million net asset test or one of the $2 million turnover tests, you'll need to also check whether the company or the trust that's being sold will be able to satisfy one of those tests. The trick there is that the way you apply those tests is modified. The grouping rules are modified. The other main change is that if the shareholder or the unit holder who has made the capital gain can't pass the $6 million net asset test, and they're seeking to rely on one of the versions of the $2 million turnover test, you will need to confirm that they were carrying on a business in their own right under general principles before the CGT event occurred. So again, just a slight change in the way that we apply what were some existing conditions. So the legislation is passed, the rules will need to be considered. You may need to go back and look at events that have already occurred earlier on in this calendar year. If you've taken a view that the concessions were passed, just revisit that, make sure these changes don't impact on that final outcome.
Now Michael is going to take you through the ATO's new guidance on those home office expenses.
Now with all the focus from the ATO on individual taxpayers and the significant tax gap that currently exists in that area, the ATO is releasing a fair bit of guidance in a number of different areas, which is aimed at ensuring that taxpayers know what their obligations are, know what they can and can't do, particularly around deductions that they might be claiming. Now, this month we've seen the ATO release an updated guide to home-based businesses, taxpayers who run a business from their own home, and what they can claim in terms of deductions. Now, the ATO makes the point, and this just builds on some previous guidance in tax ruling looking at this area, that if you want to be able to claim deductions for holding costs relating to the property, so interest expenses or rent expenses, you need to basically pass an interest deductibility test. And really that's looking at, is your home a genuine place of business or not? And if it's not, well, you won't normally be able to claim occupancy costs, but you might be able to claim some running costs. When it comes to running costs, there's a couple of different ways you can do that. One is you can use the ATO's 45 cents per hour rate. So keep records to show how long you've been working in that home office and use that to then calculate what is a fairly simple deduction calculation. Now that takes into account things like heating and cooling, electricity, and depreciation of office furniture. But on top of that, you can actually claim some other things. You might be able to claim some of your phone expenses, internet costs, depreciation on computers and other equipment as well. The ATO says if you want to be able to claim those running costs, you need a record to establish how you've come up with that deduction. The ATO suggests that in this context, home-based businesses running out of a home office, a 4-week diary is the sort of thing the ATO would expect to see. So keep a 4-week diary that is representative of your usage of that home office across the year. Take into account any times you've been on holidays and you haven't actually been using the home office, or you've been sick. So you might need to make some adjustments to that before you get your final number. But the ATO is saying a 4-week diary is the sort of thing they expect to see to justify and substantiate home office expense claims. Now you don't have to use that 45 cents per hour rate. You can come up with your own calculation. It might be based on floor area. It might be based on other factors. You need to be able to prove basically that what you've come up with is reasonable. And again, you need to have evidence to justify and support the deduction you're claiming. So keeping receipts for expenses, keeping receipts and invoices for equipment that you might have purchased and that's then used in your home office. Really important for taxpayers to know that they need to keep those receipts and evidence to justify their claims, because this is an area that is likely to be targeted by the ATO over the next little while.
And now across to Michael, looking at that Board of Taxation review into the residency of individuals.
The Board of Tax has released a consultation paper which is looking at the issue of tax residency and is potentially another step towards some possibly significant reforms in this area. Now this stems back from a self-initiated review that the Board of Tax undertook last year, provided some initial recommendations and findings to the government. And the government said, we want you to go away and explore some of these things in a little bit more detail and then provide some more final recommendations which we'll then consider at a later point in time. So there's no guarantee anything will come of this, but at this stage the Board of Tax is continuing to do some work to try and come up with different ways that the individual residency tests might be structured. And the sense is that the current residency tests are possibly a bit outdated, and certainly for lots of people coming in and out of the country, they're quite difficult to apply and often kind of have this issue around, do we know for sure whether someone is a resident or not? Now what the Board of Tax is suggesting at a really high level is a way of maybe simplifying the rules so that we have a starting point for most taxpayers where they look at a bright line test based on a certain number of days in the country. And so the idea being that most people will know with a pretty high degree of certainty whether they are resident or not based on this bright line test. What the board is then suggesting is that for those who aren't residents under this bright line test, that there will then be an alternative or secondary test which looks at a wider range of factors to establish how closely connected they are with Australia. So if people are non-residents but they still have some connection here with Australia, then there possibly will still be a little bit of a process to work through, a little bit more complex process to figure out whether they are a resident or not. But the idea being that for most people there'll be a very simple test that gives you the answer. Now, other things that the Board of Tax are looking at and seeking stakeholder views on are things like part-year residency situations. It's a bit of an odd one because it's not entirely clear at the moment how the rules in certain areas anyway should be dealt with when someone might start or cease being a resident during the year. And the Board of Tax thinks that there's an opportunity to clarify that, particularly if there are some changes to the tests. The other thing, which is probably a fairly outdated concept at the moment, is One of the residency tests is a superannuation test. It's designed to ensure that Australian public servants involved in government service working overseas are dealt with automatically as Australian residents. But the way that test works means that it's becoming increasingly irrelevant and outdated in a practical sense. And again, the board has recognised that and is suggesting that that needs some work to come up with a test that is more appropriate for modern settings, basically. So the Board of Tax is seeking community views. If this is an area where you've got practical experience or concerns or ideas on how these rules could be improved, it's well worth having a read of the Board of Taxation's consultation paper and putting forward your views. And we'll see how this plays out. Clearly there'll be nothing happening in the very short term in terms of changes to the rules, but it is an area where we may see some developments over a bit of time, depending on how the government reacts to whatever the board's final recommendations are.
And that's the tax roundup for this month. If you're not a member of Knowledge Shop already, we'd love to show you what we offer with our help desk, work paper knowledge base, and also our quarterly training. Just give the team a call on 1800 800 232. We'd love to show you how we're making the lives of accountants and public practice just that bit more simpler. See you soon.